On the same day, everyone was arguing whether silver was just a retail meme. The derivatives machine quietly did something you almost never see. CME jacked up silver margins again, making it more expensive to hold positions, right as China's silver market plumbing started seizing up. And then came the headline number that should make you stop scrolling. Silver added $297 billion in 12 hours. Not in a quarter, not in a month, in 12 hours. Here's the paradox. While Western traders were looking at charts and calling it volatility, Shanghai was pricing silver like it was a different asset entirely, premiums that briefly blew past 30% and then snapped back like something broke. So ask yourself something. Why would exchanges raise the cost of holding silver unless they were trying to slow something down? And why would Chinese retail get trapped inside a silver fund that traded 60% above its own NAV, unless the demand pressure underneath was so intense the normal rules stopped working? Welcome to the hidden economy. We break down the financial moves happening behind the curtain. Subscribe, because what we're about to cover isn't framed correctly on the mainstream screen. Now let's get into it, because this story is far bigger than silver went up. I need to set the stage quickly, because what happened before matters. But I'll keep this tight because I know you're here for the real story. The first thing you have to understand is this. Silver is not just a commodity. It trades like a hybrid monster. Part monetary metal, part industrial input, part leveraged casino chip. And when the system gets stressed, silver doesn't move like gold. It whipsaws, it gaps, it punishes the late crowd. Now roll back to late January. On Jan 27, Reuters published a detail most people read past. Retail traders weren't just interested in silver, they were hitting it harder than the classic AI trade. Vonda Research said individual investors net bought around $171 million of SLV in a single day, nearly double the 2021 squeeze peak. Reuters. Let me make sure that landed. That's not some buying. That's a behavioral pivot, the kind of pivot that tells you retail was in chase mode, momentum mode. I don't want to miss it mode. And Reuters adds another credibility marker. Combined retail plus institutional interest drove SLV volume to multiple times even SPY in that month, based on LSEG data. Reuters. So we have demand pressure on the paper side. But then something changed. Because while the West was watching ETF volume, Asia was watching physical spreads, and the spread started screaming. Notes the Shanghai spot premium over London briefly surged above 30% during the frenzy. That is not normal in a well-arbitraged global commodity. And then it dropped below 10%, signaling that marginal demand was backing off, profit-taking was starting, and the market was trying, desperately, to reattach to reality. Now here's where tension builds. Because whenever you see a giant premium in one region, one of two things is happening. Either that region has a temporary demand spike and supply is stuck, or the same asset is no longer the same asset, because delivery, access, or trust is different. And in the final weeks, the market structure itself became part of the story. Describes how a China-listed product, UBS SDIC Silver Futures Fund, the only exchange-listed pure silver product in China, traded at a premium close to 60% to its NAV, despite repeated risk warnings. Then trading was suspended, and after that it was limit down for 4 consecutive sessions without trading, effectively locking investors while losses stacked up. Read that again if you need to. A product can detach from its underlying value because of structure, limits, and liquidity. And once it detaches, it can become a trap. Now layer in the institutional response. CME, where a huge part of Western silver price discovery happens, raised margin requirements again. Initial and maintenance margins for COMEX 5000 silver futures moved to 18% from 15%. And importantly, CME had changed its methodology on Jan 13 to base margins on a percentage of contract value, not fixed dollar amounts. Translation. When price rises, your margin rises automatically. When volatility spikes, it gets worse. This is not cosmetic. This is the exchange telling participants, we don't trust the current risk profile. And then the viral headline hits, 297B in 12 hours. So on the surface, it looks like a single story, a wild rally. But here's the thing about rallies like this. Eventually, the market forces a moment where the weak hands meet the margin clerk. And on the key day, inside that 12-hour window, 2 things happened at the same time. Price action went vertical, and the plumbing started to clog. And that's the setup for what happened next. I want you to picture this, because unless you were watching a terminal, you have no idea how fast this moved. Silver doesn't politely trend, it snaps. It's a thin market compared to the capital that tries to run through it. literally says, silver is a relatively small market compared with the volume of capital now flowing through it. And when volatility rises, market makers widen spreads, reduce risk warehousing, and liquidity becomes weakest precisely when needed most. That's the core dynamic. Now compress time. A 12-hour move can happen across sessions, Asia, then London, then New York. And when Shanghai is doing one thing and London is doing another, you don't get a smooth global price. You get a tug of war. Here's how the cascade works in a leveraged commodity. Every tick higher pulls in trend followers. Trend followers pull in late retail. Late retail buys leverage products. Leverage products force hedging activity in futures. Then volatility spikes. Then exchanges raise margins. Then traders get margin calls. Then margin calls force selling. Then forced selling widens spreads. Then market makers step back. Then the tape gets thin. It becomes a waterfall. And the part that retail never sees is that the waterfall doesn't require bad news. It can happen with no headline because the headline is the market structure. Now zoom in on the China Fund story because it's the perfect microcosm. UBS SDIC Silver Futures Fund traded at a premium close to 60% to NAV before trading was suspended. Then, after volatility turned, it went limit down repeatedly, locking people in. That's not just China drama. That's a real-world example of what happens when product structure meets mania. It's like being in a building where the exit door only opens 10% per day. Now let's connect that to the West, because in the West, the exit door is margins. CME shifting margins to a percentage of contract value system means volatility can mechanically force de-risking. The moment the exchange decides you need more collateral, your broker doesn't ask you how you feel about silver fundamentals. They ask you for cash, and if you don't have it, they sell you. That's the wealth transfer mechanism in plain English. Now, what about the 297B number? This is where I need to pause because this is where most videos end, and they get it wrong. They'll tell you 297B flooded into silver, but the viral citation itself frames it as market cap. Silver reclaims $85, up 6.85%, adding 297B to its market cap. Market cap math is not cash flow math. It's a mark-to-market revaluation. A thin marginal bid can reprice the whole complex, and then the implied value looks enormous. So the real investigative question is not who sent 297B. The real question is, what caused the marginal bid to reprice silver that aggressively? And why did the system react like it needed to slow it down? And that brings us to the part mainstream coverage often misses: the spread, the regional premium, the plumbing, the signs that the paper silver market and physical silver market were not moving as one, describes banks and market makers struggling to warehouse risk and being blindsided by violent price swings, including the spread between physical and paper markets. That sentence is everything, because spreads blowing out are not a chart pattern. They're a trust event. So here's the transition you need to feel. The 12-hour move was the symptom. The real story is what it revealed underneath, about liquidity, about premiums, about margin policy, about retail positioning, and about who had to de-risk first. But here's the thing. That day was not the bottom of the story, and what happened around it made everything worse because it showed you the market's weak point. Now I need to pause here because every other video ends with "it surged" or "it crashed" and moves on, but not this video, because I'm about to show you three things, three hidden truths mainstream framing missed. And the first one, when I found it, genuinely made my stomach drop. While people in the West were arguing about whether SLV was a meme, I pulled up the one thing that tells you whether a commodity market is healthy, the cross-market premium. Notes Shanghai's silver premium over London briefly surged above 30%. Then it fell below 10%. Let me make sure that landed. That's not a technical. That's a real-world pricing contradiction. The same metal, same element, same industrial use. Two completely different effective prices depending on where you are and what you can access. For perspective, a 30% premium is the kind of gap you'd expect in a market with wartime logistics, sanctions, severe shortages, or a sudden structural bottleneck. In a normal world, arbitrage crushes that. Someone buys cheaper in London, sells higher in Shanghai, ships metal, collects the spread. So why doesn't that instantly happen? Because arbitrage is not magic. Arbitrage requires inventory that can move financing that works, counterparties that trust delivery risk limits that allow market makers to hold exposure, and basically tells you that mechanism was impaired. Banks and market makers were increasingly unwilling to quote prices in size because they were blindsided and couldn't warehouse risk. That's not just volatility, that's market plumbing failure. And here's the darker implication. When a regional premium explodes, it means the price you see on your app may be the price of a promise, not the price of immediate deliverable metal in the tightest location. That's why this matters to sophisticated retail, because institutions don't trade the headline. They trade the basis, the spread, the liquidity condition. And when that spread starts moving like a distressed credit instrument, you're not looking at a normal commodity rally anymore. You're looking at a market where the marginal buyer is signaling, I will pay up because access matters more than price. Now, also notes that premium later retreated sharply. Great. That tells you marginal demand cooled and some froth came out. But that doesn't solve the story. It confirms the story. This market is so unstable that it can swing from extreme premium to normalization in weeks, because a relatively small shift in flow overwhelms liquidity. That's why the 297B mark-to-market headline is plausible, even if cash inflow isn't. In a smallish market, the tail can wag the dog. Now here's the transition. That premium is the first hidden truth. The global silver market was not one market. It was multiple markets temporarily breaking apart. Now here's the second thing nobody is showing you, and this one is just as wild. On the Western side, the most important signal wasn't a candle. It was a policy lever. CME raised margins. Silver futures margins to 18% from 15%, effective at Friday's close. And since Jan 13, they're using a percent of contract value model. That's the action. Here are the details and why they matter. Margins are the deposit you must post to hold a leverage position. When the exchange hikes them, it does two things. It forces weak balance sheets to cut exposure. It reduces systemic risk by moving the deleveraging into the present. Think about what that means. They didn't raise margins because they were bored. They raised margins because volatility was elevated and risk was rippling through precious metals markets. But here's the paradox. Margins rising should cool things down. That's the point. And yet, we still got violent moves, premiums, and a headline-level revaluation event. Which means you had flows strong enough to push price anyway, or positioning fragile enough to snap anyway, or both. Now connect this to the China fund incident. Description is brutal. The UBS SDIC fund structure plus daily price limits allowed it to detach from underlying value during the rally, and then worked in reverse when volatility turned, locking investors. So in China, the brake pedal was price limits and suspensions. In the US, the brake pedal was margin. Different mechanisms, same goal, stop the system from spiraling. Now here's what kept me up. Retail was the visible face of demand, SLV flows, record turnover. Reuters. But the exchange doesn't react this hard for retail alone. Exchanges react when the structure is at risk. So the deeper question becomes, if the system was preparing for volatility, raising margins repeatedly, who was positioned in a way that could break something if silver moved too far, too fast? Hints at concentrated positioning risk. Reporting identifying a large net short on SHFE in a market prone to S. And then you add the Western dynamic. When margins rise, shorts and longs both can get stressed. But in a squeeze-like environment with premiums and delivery concerns, the pain can become asymmetric. Now here's the transition. Hidden truth number 2 is that the global freeze story isn't science fiction. It's what happens when exchanges and product administrators start pulling emergency levers, not because of a headline, but because liquidity and positioning are becoming incompatible. And that brings me to the third thing. This is the one I saved for right now, because you needed to see the spread and the policy levers first. Here's the major move that connects everything. Silver demand wasn't just speculation. It was a two-front war between paper exposure that can be created instantly and physical region-specific exposure that cannot. Literally describes a world where market makers struggle not just with outright price swings, but with the spread between physical and paper markets. That's the key phrase, because it implies the market was fighting over what silver even is, a contract or metal. Now think about this for a second. You don't get a 60% premium to NAV on a China silver fund, then suspension if the underlying market is calm. You don't get Shanghai premium briefly above 30% if the world is awash in easy-to-move inventory. And you don't get CME raising margins repeatedly, plus changing methodology, if the exchange believes the market is behaving like a normal commodity. So what is the hidden pattern mainstream framing misses? It's this. The 12-hour 297B flood is not a story about money arriving. It's a story about liquidity leaving. When liquidity leaves, a smaller marginal order can move price farther. That revalues everything. And then the mark-to-market headline looks like hundreds of billions appeared. But underneath, what's happening is more disturbing. Participants are learning, fast, that in stress, silver exposure is not one thing. It's like watching a billionaire quietly sell his Manhattan penthouse and buy farmland. You don't ignore that. Now let me connect all these dots into one narrative that changes everything. Retail chase hits Western paper instruments. SLV sees record net buying day. Turnover runs 11x usual pace per Vonda. Reuters China product shows how structural constraints turn a rally into a trap. 60% premium to NAV, then suspension, limit down lock. Regional premium explodes. Shanghai versus London premium, briefly above 30%. The market screaming that access and immediacy are being repriced. Exchange responds. CME raises margins to 18% from 15% and makes margin dynamic with contract value, forcing deleveraging when price rises. Headline revaluation, 297B in 12 hours. Market cap framing, not necessarily cash, amplified by social virality. Community moment. I want to know what you think. Drop it in the comments right now. Are we watching a normal speculative blow-off? Or are we watching a market where the paper and physical definitions are separating under stress? Because that distinction changes everything. Here's the timeline one more time, and I want you to feel each entry, not just read it. Feel it. Mon, Yan. 27. Retail hits silver hard. 171 milliliters net buy into SLV in one day. Chase more intense than AI trade. Euphoria. Reuters. Late Jan, early Feb, China's pure silver fund detaches, premium near 60% to NAV, warnings ignored. Delusion. Fry, market turmoil window. Trading suspensions and limit down dynamics lock people in. Panic. Early Feb. Shanghai premium over London briefly 30% plus, then collapses under 10%. The scream. Feb 6 reported. CME raises silver margins to 18% from 15%. Risk control goes harder. Intervention. The viral window, silver up 6.55%. 297B market cap in 12 hours. Shock. Look at that timeline. Look at every single entry, and you tell me that's a coincidence, because I've stared at it for hours, and it refuses to feel random. Now let's bring in an expert framing, because you deserve something sturdier than social posts. Bank's commodities team frames it like this. Until volatility subsides and price discovery improves, gold, and especially silver, can trade violently in both directions. And they stress that market mechanics are dominating, not macro headlines. At first you might think, okay, that's just a normal volatility warning, but then says the part that stopped me cold. Banks and market makers have struggled to warehouse risk, and the spread between physical and paper markets has been violent, reducing willingness to quote size. Think about what that means. If the people who make markets don't want to make markets, the market becomes a hallway with fewer lights. It wasn't fundamentals that cracked first, it was liquidity. Now here's the historical parallel you should keep in your head, without getting lost in nostalgia. Every time you see a market where retail chases the liquid proxy, the physical market develops persistent premiums and exchanges start changing margin frameworks, you are watching the system try to prevent a leverage-driven feedback loop from becoming a solvency story. That doesn't guarantee a bull market continues. It doesn't guarantee a crash continues. It guarantees one thing: the easy phase is over. The tourist phase is over. What's left is the battle between real buyers, forced sellers, and risk managers. And that is exactly when wealth transfers hands. Let me be very specific about why the bounce matters, if you're trying to read signal instead of noise. When a bubble truly pops, you don't see coherent bids where it matters. But in this case, the system showed you something else. Even while volatility was chaotic, there were still participants willing to pay premiums regionally, and there were still flows strong enough to generate a massive mark-to-market revaluation headline. And remember that 297B number is likely market cap math, which means price moved enough that value repriced fast. That's not a guarantee of up only, but it is a signal that the market is not dead. Also, the Shanghai premium behavior is critical. Premiums exploding and then retreating implies the market went from urgent buying to profit-taking, but the fact it got that extreme at all tells you physical demand and access constraints were part of the equation. And when corporations, or funds, or sovereign-linked actors start behaving like access matters, they often bypass the paper convenience and go directly toward the channels that can actually deliver. That's why these S matter more than the candle. Because a futures chart can't fully capture the price of immediacy. Now I always give you the full picture, because you deserve both sides. Real risks. This was speculative behavior. The Reuters data shows intense retail chase into SLV, and also heavy activity in inverse products like ZSL, meaning people were betting hard both ways. That's not stable positioning. Reuters volatility can stay violent, is clear. Until volatility subsides and price discovery improves, silver can trade violently in both directions, and liquidity can be weak when you need it most. Exchange margins rising can force more liquidations. CME moving margins to a percent of contract value model can mechanically intensify deleveraging during big swings. Critical disclaimer: this is not financial advice. Do your own research. Talk to a professional. Never put in more than you can afford to lose. Here's what I'm watching this week: the actual forward signals, not vibes. CME margin updates. If margins keep ratcheting higher, it means risk managers still see structural danger, not just normal volatility. Shanghai premium behavior. Does it stabilize or re-widen? Premiums are the lie detector for physical tightness versus paper repricing. Normalization. Does that 60% premium to NAV type behavior disappear, or does a new product become the next pressure valve? I'll be covering it all on this channel. Before I give you my personal take, I want you to sit with 4 questions, because I've been trying to answer them from the bearish side, and I cannot do it cleanly. If this was just retail mania, why did Reuters document record institutional grade turnover and flow intensity in the main proxy? Reuters. If silver was one unified global market, why did Shanghai trade at a premium that briefly exceeded 30% over London? If everything was normal, why did China's only pure silver fund trade 60% above NAV and then trap investors under limit down mechanics? If this was just noise, why did CME keep tightening the screws, raising margins and changing how margins are calculated? Nobody mainstream answers all 4 at once, so let me try. Here's my personal take, not as a financial advisor because I'm not one, but as someone staring at this market structure. I think the $297 billion in 12 hours headline is the wrong sentence, but it accidentally points to the right reality. I don't think 297 B's of new money literally arrived. I think we watched a moment where liquidity thinned, spreads widened, product structures broke, and the marginal bid repriced the entire complex, creating a mark-to-market flood that looks like magic. And what really bothers me on a personal level is this: wealth doesn't disappear in moves like this. It transfers from people who chase proxies at the top to people who understand margins and spreads, from people who buy because it's trending to people who buy because access matters, from people who panic at the red screen to people who know the exchange just forced someone else to sell. That's a wealth transfer, and it happens every single time. That's why I make these videos, not to tell you what to buy. I genuinely don't care. I make these videos because the biggest disadvantage regular investors have isn't money, it's context. And in this story, the context is silver isn't moving like a single instrument. It's behaving like multiple instruments that only look identical when times are calm. That's the answer to the question from the beginning. Why would exchanges raise margins, and why would China's market show extreme premiums in product S? Unless the system was trying to control a leverage and liquidity problem? Now you know, and now you know why the surface narrative, silver went crazy, is true but incomplete. Because the premium data and the margin policy tell you which direction this story is really pointing, toward a market where the definition of silver exposure matters more than the ticker. Drop your take in the comments. Is this a pure speculative blow-off or a structural repricing signal? I read every comment, and the sharpest analysis on this channel comes from you. If this connected dots you hadn't seen before, send it to one person who needs to see this. And if you're not subscribed, fix that. This is the hidden economy. I'll see you in the next one.